All right, here are the answers to the technical analysis questions. Now, I hope that you got them all right, but if there were any that you didn't, then I'll explain the answers now. Right, first up, a P-shaped day on the volume profile indicates what? Now, a P-shaped day is going to be a day where you have a very thin lower part of the volume and then value accumulating higher, creating essentially a P. Now, what this is an example of shorts covering. Shorts in the market have got out of their trade, and that's what's got that initiative move higher, and so that's why you get that thin part of the profile. But because it's not been done with there's no further buying in the market, you then just get consolidation higher up, value accumulating towards the top of the profile, hence the P shape. A market trading below VWAP is perceived as offering good value to who? The VWAP is seen as a measure of value. It's the volume weighted average price, so the average price where volume is evenly distributed either side of it. Trading below it is perceived as offering good value to buyers. If you can buy below value, then it's offering you good value. Conversely, trading above the VWAP is good value for sellers. Question 3, a hammer at the top of a range is known as a hanging man. It's exactly the same candlestick pattern as a hammer, so you will have a long tail to the downside and then a small body on the candle. However, if this is at the top of the range, it is actually a reversal signal, because what has happened is you've reached the top of the range, we've had some selling, buyers have come back in and driven the market back up. However, they're not managing to close the market any higher, but still closing it at the top. If you then start seeing trade back into that tail, that is going to get those buyers who bought it back up to get out of their trades, and that is why it is a reversal signal if seen at the top of a range. Right, one time framing. This indicates a stronger or weaker move and is led by longer or shorter term traders. It's indicating a weaker move and it is led by shorter term traders. Reason being, one time framing occurs when say we're one time framing higher, the market does not take out the previous day's low. Therefore, each day that anyone enters a trade, you don't have to be a particularly strong hand. If you have a stop below the previous day's low, participants do not get stopped out. Therefore, weaker hands can stay in trades. And this is often a case of shorter term traders are looking for these types of moves where you don't get put under any pressure. Longer term traders are going to wait for the market to come back off, to pull back to areas to get back in. If that's not seen, then it is just a case of weaker position traders, generally shorter term as well, which is where you see the one time framing moves, which when they reverse, often reverse quite quickly as those traders get out of the trades. Right, why do levels become weaker the more times they are tested? Reason for this is each time a level is tested, you will see more participants act at that level. So if it's a support level, each time it comes down to it, you will get more and more people accumulating positions long at that level. Therefore, as the positions are accumulated, the level becomes weaker, because if it comes back once again, you've now got more people who could well get out of their trade looking for a scratch, or perhaps if it ticks through the level, getting out. So a level becomes weaker because you've got more and more positions that are potentially going to get out at the level rather than hold on to the level. Question 6, these were some of the chart questions. So we've got a 15-minute euro dollar chart here. The flag breaks at 1.0996. Which level is the flag target? Those three red levels lower down. Your target is 108.33. Reason for this is the pole on the flag is from 111.43 down to 109.80, which gives you 163 ticks. If you subtract the 163 from the 109.96 break, gives you a target down at 108.33. As you can see, we didn't actually reach the target on this one, and so you would have ended up being disappointed if you were holding it right the way to target. Right, double bottom pattern on a weekly Italian BTP chart. What would confirm this pattern? As with all technical patterns, you are going to need a close, and to confirm the pattern on a double bottom, you need to see a close above the most recent swing high. If it's a double top, it's a close below the most recent swing low. So that comes in at 131.07. That's where you need to see a close higher than that level. Next question, if you're long based on this pattern, where would your target be? On a double bottom pattern, your target is the next swing high. So once you've broken the most recent one to confirm the pattern, the target is the next swing high, which is obviously at point D. And finally, based on the ATR, the gold histograms, what would you expect it to reach any of the aforementioned targets within a week? So your ATR is 1.88. The break of the double bottom pattern comes at 131.07. So if you add the 1.88 to 131.07, you get 132.95, which, as you can see, is not going to reach point D, and obviously it would not reach any of the other patterns. So the answer to that is no. It could well do it. It's not to say that it will not, but the expectation is this trade will probably take more than a week to reach its target up at point D. Question 9, market profile or volume profile question now. What prices are the last 2 days VPOCs? VPOC, your volume point of control, is the highest volume traded price. So you can see the peaks of volume on those prior 2 days, which are also marked off in pink as well, are at 160.59 and 160.58 on the first day. So there you go, 160.58, 59 are your two VPOCs. Now, hopefully you will have noticed on the first question that this is a case of shorts being caught in the hole. The market has closed below value. It has closed lower volume as well. That's those two stars which show where the close is. So you're expecting the market to reverse if shorts do not see a further move through lower prices. So where would your stop be if you were initiating a trade buying through the open? So you're buying 160.24s. Where would your stop on that trade be? The appropriate stop will be down at 160.10. Reason for this is at 160.18, shorts are still in the market. The shorts could well have not been proved right, for one thing, so they could well still reverse the trades. They could still have to get out. The market could say trade 18s, 17s, then start coming up, and you will still get those shorts caught in the hole. Whereas down at 160.10, the shorts are no longer caught in the hole. They're getting the trade that they want, and this could initiate more selling as well. So 160.10 would be the appropriate place for a stop. 159.00 possibly won't get you stopped out, but it's 125 ticks lower, so a big stop for what you're looking for as a target. And that leads on to the next question: where would an appropriate first target be? Now, your first target on any trade like this is a look back to previous value. So you look into the value area low, which comes in at 160.44. You always look for the value area low. If there are any bigger short positions that want to come in, they may well come in at that value area low and then look to get the move going again. So you're looking for a test of value. This allows you to cover a bit of the trade, and that's why it's your first target. If the market establishes inside value, then your next target, of course, would be the VPOC up at 59. Being as that is prominent, I would say that is a target that could well be on, but your first target should be 160.44. Right, the market trading below its lower Bollinger Band is viewed as oversold. It could well be trending, but it could have just pushed out. It could have gapped below the Bollinger Band as well, so it's not necessarily in a trend. but it is in an oversold position. It is more than 2 standard deviations away from the 20 period moving average. So this is deemed as oversold. And what you would then be looking for is a move back inside the Bollinger Band. That's where your trade is. With an oversold situation, it doesn't mean that there's necessarily a buy to be had. The market could stay oversold for quite long periods of time. So be very aware of that. You're waiting. Once you get back inside the Bollinger Bands, then you have a trade. And where would you expect it to trade to? If you're using Bollinger Bands, your target is going to be that middle band. You're going to see a move back to the middle band, and then it's going to be a case of, do you use the middle band as a resistance and the market continue to move lower? Then we could well be trending. Or does it then break and reach the upper band? But your first target would be the middle band. That's where you'd expect it to trade to on a move back inside. Final question. In general, high volume nodes will attract prices. The reason for this is it's been a fair price to do a lot of business at. That's why you've got high volume there. A lot of business has been transacted at those prices, and so prices are attracted back there to see if there is any more trade to be done at those prices. If there isn't, then it will either reject and move away or just trade straight through, but it does usually attract the market back to test if there are any more buyers and sellers at those prices. Okay, that is the end of the quiz. So hopefully you have now got the knowledge on some of those questions if you did get any wrong. If not, hopefully I might have added a little bit to the ones that you got right.